Hello, welcome to ME 510, Economics and Policy of Engineered Energy Systems. This presentation is part two of a three-part module on the future of natural gas, a discussion on a report by the Massachusetts Institute of Technology report on natural gas. In this part two presentation, we'll start off by looking at the economics of delivering a natural gas. In this particular slide, we're looking at the break-even gas price at the point of export, so where the natural gas is collected from the well and eventually shipped to consumers. What you find is if you're looking at liquefied natural gas, we talked about the additional cost of compressing it, in this case called liquefaction. Liquefaction costs about $2.15 per million BTU, which is the major cost contributor here. Once you have it compressed, you can ship it to consumers, and pumping costs and fees all add up to about $1.25 per million BTU. Finally, that liquefied natural gas has to be regasified or expanded in order to be delivered to the consumer, and so that adds about 70 cents per million BTU. You can see from the economics here that if natural gas market prices are at $3 a million BTU, as they have been in the not so recent past, liquefaction can be a fairly expensive proposition. Now, if you look at low, mean, and high estimates for these prices and the amount of liquefied natural gas that will be available in the US, you can develop these supply curves. So what the supply curves show is that at a low price, about $2 to $4 per million BTU, there isn't much difference here based on the different potential costs of producing liquefied natural gas. You'll have a similar range of supplies. However, in order to supply 12,000 trillion cubic feet of natural gas at a price of $4 per million BTU, you start seeing some divergence in the amount of natural gas that will be available. Obviously, if the price increases significantly, so as high as $20 per million BTU, you can see the United States producing more than 15,000 trillion cubic feet of natural gas, or as little as 12,000 trillion cubic feet of natural gas. And that just goes to show the uncertainty in how much natural gas could be produced based on the market price. If you look at this from a global perspective and you try to develop a break-even gas price plot, you'll see that some countries, particularly the Middle East, can provide the majority of natural gas depending on the price. Again, we know that they have the highest reserves. And so at $20 per million BTU, they will be the clear leader, followed by Russia and the US third. But that's not a big surprise. But what we do see is that once the price of natural gas goes below $5 per million BTU, there's a very rapid decline in the amount of natural gas that would be supplied by Russia and the Middle East. And this is because transportation to consumers starts becoming a major factor. Other countries, Mexico, for example, are not as sensitive to the price of natural gas. The amount of natural gas that they could provide to the world is constrained by other factors, either supply constraints, infrastructure complaints, or even political constraints. In the US in particular, it's often something that people don't realize that natural gas can be delivered to virtually anywhere in the country. Clearly, the dense region towards the south in the state of Texas is where a lot of the natural gas has been conventionally recovered, and it's a lot of petroleum-related industries there. However, the infrastructure that we have here can take us all the way to Alaska. We have pipelines crisscrossing all around the country. The gaps that you see here are regions that are not densely populated, but anywhere that you have urban and even rural communities, you can deliver natural gas to. The U.S. Energy Information Administration likes to divide the U.S. into the regions shown here. You have the western region that includes California, Nevada, Idaho, and then you have the central region where we have Iowa on one end and Utah on the other end. The southwest region is mostly dominated by Texas, but you have Louisiana and New Mexico on both ends. The southeast region, the Midwest, and the northeast. The reason I show that map is because we're going to look at how the Energy Information Administration estimates that the growth in shale gas production will come in the US. And as you can see from this chart, they expect that most of the growth in natural gas production will come from the Southwest. Again, we have a huge refining infrastructure there, so it's not a big surprise. What is a big surprise is the growth in production from the central region, and this is because of the shale gas revolution. So we'll talk a little bit about why the central region is becoming such an important player in the production of natural gas in the US. If you look at a breakdown by type of natural gas being produced, again, from 2000 to 2009, this is a historical fact now, shale gas has dominated the growth in production, going from as little as 1% of the natural gas supply to 14% in 2009. This is due to decades of investment in fracking technology and other types of unconventional natural gas recovery technology. You can see that tight gas production has also increased, and what has decreased is associated natural gas production and conventional production. I say decrease, but it's just decrease in its percent of supply. The total production is actually fairly comparable to what has been historically. Conventional production, however, as we can see on the left, has declined significantly. For these different types of natural gas resources, we can develop supply curves as we did before. And you can see that conventional natural gas has an interesting supply curve compared to shale gas. At low natural gas prices, you expect to see a greater production of conventional gas than shale gas. But as you increase the price, you can see that there's a crisscrossing here. At high prices, because conventional gas is a low-cost technology and there's a large supply of conventional gas, you can see that at prices above $18 per million BTU, conventional natural gas supply would dominate. But at $8 per million BTU, currently shale is the most promising way of producing this natural gas, and so it has a higher production and a supply curve. However, if you look at tight gas, a little bit less sensitive to the price of natural gas, and its supply is constrained by other factors, mostly technical at this point, but we could see a shift over time on that supply curve if the technology improves. If you look at the production rate, these are 3 different shale gas locations. One interesting thing that is very particular to shale gas technologies is that their wells have a relatively rapid decline in production. And so if you look at the production rate on a 30-day average from these locations, over 5 years, if you look at Haynesville, it's gone from about 8,500 cubic feet per day to less than 1,000 cubic feet per day in just 5 years. And that just goes to show how rapidly some of these shale gas formation production rates can decline. And when you open a shale gas location, the probability that you'll have a very high production rate from the beginning can actually be fairly small. As you can see here, the probability is that most of these wells would start out with between 1,000 and 2,000 cubic feet per day. But it could also be as low as a couple hundred thousand cubic feet per day. And so this shows a comparison of the probabilities in production rates and market prices for natural gas on these shale formations. You can see, for example, for Barnett, there's a 20% probability that the production rate will be above 2,700 cubic feet per day. and there's a probability of 80% or so that will be only 860,000 cubic feet per day. On the other hand, corresponding to those production rates, there's a 20% probability that you could sell it at $4.27 per thousand cubic feet, or the cost of producing it could be as high as $11.5 per thousand cubic feet. And that just goes to show that any investment in this shale gas formations is fairly risky, because until you tap that well, you don't know what your production rate is going to be, and you don't know how long that production rate can be sustained. But certainly there is some variability here between the locations. For example, Marcellus has a very low range of uncertainty, so that's a less risky location from which to get shale gas. So if you look at Marcellus specifically, you can see here a plot of break-even gas price versus condensate ratio. What the condensate ratio is the amount of oil generated per amount of natural gas in terms of million cubic feet and barrels of oil. So if you have a condensate ratio of 50, that means that you're producing a lot of oil, and you produce enough oil that you can give away the natural gas essentially for free. But if you're not producing any oil, then you have to sell the natural gas for at least $4 per million BTU. And this analysis assumes that the liquid price is $80 per barrel. Obviously, with oil being below $40 per barrel, you'll have a different shape to this curve. Now, the interesting thing, or the promising thing about all these formations, is that we anticipate that most of the shale gas locations haven't been developed at this point. And so if you look at where we are in 2016, we still anticipate that many of these locations will see an increase in natural gas production all the way to 2030. And now we'll move on to part 3 of the natural gas discussion.